Hey guys, welcome to Kiwoon Learning, and this is the basics of investing. Now in this video we're going to be going over what kind of investor are you. Now the reason why this is important is because later on in these lessons we're going to be talking about different stock patterns, different things you have to look forward to, but depending on what kind of investor you are, it determines what you need to know and not. Now there are two main different types of investors. There are active investors and there are passive investors. Now I'm going to be going through the pros and cons of each one so you can determine where you fit in. Now the first one I want to talk about is passive investing. But what exactly is passive investing? Well, another way to say passive investing is buy and hold strategy, because it's in the name. You buy a stock and you hold on to it for dear life for many years. Now typically passive investors look into funds or larger market cap stocks. If you don't know what a fund is, imagine you have a room full of toys and you have 3 different boxes labeled action figures, technology, and Legos. So what you do is you take your Legos, you put them in the Legos, and you do the same with all the other boxes. Now in those boxes, there are going to be different pieces of toys. Maybe one Lego is white and it's curved, maybe another one is blue and it's a 2x2. However, what matters is that they're in the same category. Now putting investing terms into that, the little toys inside of each box, those are securities, or other known as stocks or cryptocurrencies, gas, whatever you can name. Those are the little pieces, and the box are the funds. So when you invest into a fund, you're investing into that box. Now what this allows is, let's say a stock were to plummet. Now what would happen is the other stocks inside the fund would help dilute the losses and you wouldn't lose as much. However, the same is true if a stock skyrockets. The other stocks will dilute it and you won't make as much profit. And what a large market cap means is that the market cap essentially is how much money that the company puts into shares. So how much money that they allow for people to invest their money into. And usually a large market cap stock is over $10 billion. Now going back to why passive investors invest into these things, it's because these investments tend to have a high percentage of increase. Now that doesn't mean that it's going to go up a lot, but there's a very high percentage that it will go up. So for example, let's say you invest into an index fund. Now what this does is it tends to follow the pattern of the stock market. Now when looking at the stock market, you see that there are a couple dips now and then, but there's a very general line going up. And this is what passive investors are looking into. They don't want to have to worry about investing in a certain stock and having to worry if it goes up or down, to buy or sell or to hold. They want to just leave their money and know that it's going to grow. Now the same is true with large market cap stocks. These are usually businesses that are very well developed. Things like Amazon, Coca-Cola, Apple. So let's go through the pros of passive investing. The first one is that you don't have to put so much time into investing. Maybe you have a family, a job, or maybe you just don't want to worry about investing. What passive investing allows you to do is to let your money sit and you don't ever even think about it again. The second is it's very safe. Now when you're investing passively, typically you're investing more into the stock market instead of an actual company. So as we talked about before, the stock market generally tends to have a positive uptrend. Now compare that to a smaller market cap stock, there's variability in it and you have to worry about maybe it'll go up or maybe it'll just go straight down. And these are things that you simply don't have to worry about passive investing. Now the third thing is that passive investing is beginner friendly. Now the thing about active investing is that you have to have knowledge about the stock market. You have to know about how to analyze charts, how to look at the data, how to look at quarterlies, all these different things that stack up and require time to understand about the stock market. Now investing passively, you don't have to know that as much. Obviously there's things that you have to know about. However, when you look at a passive investor, they're focusing more on the fundamentals, whether they think that the business will be able to do well in the future. And these are things that honestly everyone can do. Now the fourth pro is that you don't have to pay as many taxes. Now when you buy and sell a lot, you have to pay high taxes because that is when you get taxed. However, let's say you buy a stock and you let it hold for years, there's not going to be as many taxes compared to buying and selling maybe monthly. Now let's talk about the cons of passive investing. Now the main one that's pretty big is that passive investing doesn't allow for short-term gains. It's more long-term. You let your money sit for years and years. Now, let's not get this mistaken with you don't get as much money as active investing, because think about the most influential investor that you know. Chances are it's Warren Buffett. And Warren Buffett has made billions and billions of dollars from passive investing. And this is because he let his money sit in companies and just let it run and let it grow. And this is because he focused on the fundamentals and he did a lot of research beforehand. Now, and basically that's really the only con to passive investing. You just don't get money in the short term. which is really great. And this is what's so great about passive investing. Everyone should be passively investing because this allows your money to grow almost with 100% guarantee. Now, this is only if you do it correctly though. Now, let's get on to active investing. So what exactly is active investing? Active investing, unlike passive investing, you're not focusing on the long-term fundamentals. Typically, you're looking at maybe day-to-day patterns or week-to-week patterns, maybe month-to-month patterns, but you're looking at the data and you're looking at the stock prices and their fluctuation. Now let's talk about the pros and cons of active investing. Now the first pro is that, as we talked about before, there are short-term gain possibilities. Now this is because instead of investing into the stock market, unlike passive investing, you're investing more into a company. And this means that there's more variability. So let's say you put your money right, you buy low and you sell high. That's a big profit that probably could have taken you maybe months. Now that's kind of really the only pro that comes with active investing. However, there are several cons to active investing. Now the first con is that it's much riskier. And the reason why is because the shorter the time interval between your buying and selling, the more risky it becomes. So there's swing trading and there's day trading, for examples of active investing. Swing trading involves maybe a week, maybe a little bit more, a little less. But these investments, you hold for a week, you ride their momentum, and then you sell them and then go to the next one. Now what day trading is it's in its name. You buy and sell stocks by the day. So we're looking at very, very small margins, but very high volatility in a very short amount of time. Now, while you may make more money from day trading or swing trading, this is very risky because high volatility means that you can make a lot of money, but if you want to lose a lot of money, high volatility can do that for you as well. Now, what volatility means is that, let's say someone said that a stock is very volatile. That means that the stock moves up and down in a very short amount of time. Now, what volatility allows is for people to ride the uptrends and then sell before it goes down. And this allows for short-term but very quick profits. And where volatility can be bad is the vice versa. You buy at a high and you sell at a low and you end up losing a lot of money because it fluctuated so much and you were not expecting it. Now, another problem with active investing is that it's very time consuming in terms of both sides, the education side and actually investing. There's a lot of things that you have to know in order to actively invest. You have to know about the patterns, as we said before. And as well as even when you're investing, there's a lot of time that has to be involved in it because you have to read data charts, you have to analyze the patterns of the stock itself, and this can take a lot of time. And the third thing is that you have to pay a higher tax. And this is because, as we said before, if you buy and sell more, you have to pay a higher tax because that is when you get taxed. Now, how you know if active investing is for you is you have to have a high risk tolerance. You have to be able to handle that you're going to be losing money at some point, maybe even quite large sums of money, but you have to be able to hold it in, keep your composure, and just keep investing to make back those losses. And the second thing is maybe you want to get profits quickly. You don't want to have to wait for years. You want to get it, you want to get returns very quickly. And the third thing is maybe you're willing to take the time to learn about the data, about the patterns, all these different stuff that are involved into it. And if you have all these three traits, maybe active investing is for you. Now, if you don't have those traits, maybe passive investing is for you. And honestly, passive investing is something that everybody should do because it's beginner friendly, there's low risk involved in it, and there's not a lot of time that you have to put into it. Now, if you do want to become an active investor, it's important that you also passively invest. Good active investors have a combination between the two because passive investing will allow yourself to keep up with the slowly lessening worth of money, which is important because if you let money sit, you're actually getting poorer. Another thing that you can do is invest into investment banks. One very popular one is Goldman Sachs. However, there's a lot of other ones. Now, what investment banks allows you to do is allows you not to worry about your money, and it allows you to have a team of experts working on trying to make as much profit as possible. Now, while this sounds great, the only problem is that there's a high cost. They take a percentage of your profits, and these percentages can add up pretty quickly. Now, to wrap things up, let's just go through the three things that I talked about. So if you don't want to touch your money at all, and you want to make sure that you make good investment decisions, maybe you can look into investing into an investing bank, or you can speak with a financial advisor and get assistance on investing. Now, if you want to do a more hands-on approach, then you can do either of the two, passive investing or active investing. With passive investing, you make long-term profits, and depending on what you invest in, you could be potentially making less profit. However, there's also the security, less time needed, less education needed, and overall less stress involved into the investing process. Now compare this to active investing. Active investing allows for short-term profits and potentially even more money. However, there's the downsides. More time is needed for it, more education, and overall more stress is put into it. So if you are able to take in the fact that you may lose a lot of money, then active investing might be for you. And that wraps up the video for today. I hope you guys enjoyed. Please like, subscribe, leave a comment if you want to, and peace.